Since
Yeah, let's wait for the commissioner. I see he's trying to get in.
okay.
Azim, you want to share what prohibited you from being a world-class athlete?
No, we're not.
Yeah.
Oh, sorry, okay.
Yes.
Oh, we're back on.
Mike.
Okay. Right.
Bill has joined.
Sarah, we do have
Oh, great. Commissioner's on. Very good. Well, we
Yeah,
can
some of
call.
us got a different link.
Let's talk about that in a minute. Let's call the meeting to order. I will be chairing the meeting today for Jerry, who's had a loss in the family. Very sorry. Um, and I guess we'll begin with a roll call.
Sure. As a reminder, we are live streaming and recording this meeting. Both of those processes have already started. Additionally, if any board members attending virtually need to leave the meeting at any time, please post in the chat or let us know, as we may be taking votes without a roll call and need to comply with statutory requirements regarding virtual public hearings. Jerry Abrahams, Phil DeFranco.
Here.
Zani Imitowski. Catherine McKinnon.
Here.
Commissioner Perez.
Here.
Franklin Perry.
Here.
Sarah Sanders.
Here.
We do have a quorum in attendance for the meeting.
Very good. Well, good morning, everyone. And a quick question, Dawn, is there a way to send out the Outlook without a Teams link?
Yeah, my apologies. When they were sent, Outlook automatically attaches a Teams link, and I didn't realize that. So for next month, I'll resend them and make sure that that is not there.
Oh, perfect. Okay.
And also, Madam Chair,
Yep.
I mean, sometimes I got 3 meetings for CHFA, for the same day. I mean, this is very confusing. I attend a lot of meetings, and to be honest with you, I don't have those kind of issues with any other board or commission or meetings that I attend. So can we minimize how many times we change them? And it's not like we're changing the date or the time, but why do we get cancellations and then another one and then cancel and another one? I mean, I had 3 different invites for this meeting this month and last month.
Well, there's the hold that Dawn sends us, I think. Dawn sends us a hold.
That explains one of the 3.
Yeah.
I apologize for jumping in.
No, please do.
We're not doing the holds this year. I've sent one meeting for every for one Outlook invitation for every meeting that we're holding. Commissioner, maybe I can reach out to Kanisha and she and I can work on that.
Okay. I mean, am I the only one that got more than one invite? Am I so lucky? Maybe I should go and play the lotto. But go ahead. I don't want to delay the meeting anymore. Go ahead.
Okay, thank you. Okay, our first item is the amended resolution regarding the credit facility for the Federal Home Loan Bank of Boston. Over to Hazim.
Good morning. From finance, we just have one action item. So as Sarah said, 3 years ago, the board permitted CHFA to borrow directly from the Federal Home Loan Bank of Boston as an alternative to bond finance to help fund program loans, specifically the 9% low-income housing tax credit projects. CHFA has utilized the FHLB facility 3 times, and this morning is seeking a 3-year extension to the existing resolution. I'll be happy to answer any question regarding the amended resolution.
Can you remind
That's it.
us how this program fits in with the other sources of funding, and is it lower cost? It seems like we don't use it heavily, but how you decide when and where to use it?
Sure. So as described, is an alternative to the bond finance. And what we generally would do is when we present a loan resolution to the board, we receive authority to make the loan and to issue the bonds. At the same time, because the 9% low-income housing tax credit financing, the loans are generally much smaller in size, and the timing of the closing, it varies because when we provide the financing is based on a forward funding where the project is receiving a taxable construction loan elsewhere. So from time to time, when the funding is required to place the permanent loan in place, if the timing does not fit the bond financing, we would utilize the home loan bank facility to provide a permanent financing. So in part is due to the timing. The other one is due to the loan size. And of course, the execution, and Sarah, to your point, they do provide a good interest rate for their product. The only challenge with the home loan bank execution is they don't provide anything in excess of a 20-year term. So when we do provide and utilize their financing, we would bifurcate the whole product with our ITA.
Commissioner Perez, I'm sorry for interrupting you. Go ahead.
No, no problem. You have one of my questions, which I don't think it was answered. You know, compared to the bond rate, is it low? It should be. I think I know the answer, but compared to the bond rate, how's the rate? Is it high? Is it lower? Because this is short-term financing, so it should be lower. But
right, it's lower. The Federal Home Loan Bank execution rate is lower. However, because, like I mentioned,
but it's not fixed.
It is fixed. So let me
Yeah, but
just.
it's not fixed for 45 years or for all the 30 years, right?
Correct. That's essentially what it is. We do have a mismatch in terms because when we provide a loan, we are providing a 35-year loan product. But for Federal Home Loan Bank, they don't provide a product in excess of 20 years. So we do have a gap of the remaining 15 years. And that's where we would utilize our balance sheet to cover that gap.
I have 2 other questions concerning this. I see in section 10, it doesn't have page numbers, so but section 10 says that the facility will not be more than 45 years. Do we
Correct.
actually do 45-year loans?
No, not at the present time.
I hope we never do. There's some loans that we should never do. And one that needs that kind of subsidy may not be a loan that we should be doing.
Right.
I mean, the
Yeah.
president suggested 40, and he was mocked by every financial guru there was in the world,
Right.
Democrat or Republican. Nothing to do with the party. It's just not good
Yeah, but keep in mind,
financing to
right,
do something for 45 years.
right. But just keep in mind, when we came out with that 45 years, the additional 5 years, we were also contemplating if there is an interest only to cover for the construction period. So it's 45 years, not to say that the loan is amortizing over 45 years. It's the fact that you still need to provide and cover for the construction.
Well, again, we could have that philosophical discussion at another time because even if it's if
No,
it's
and
5 years for interest only,
right,
even though that's a long period of time, you
correct.
know.
Yeah,
I mean, there's some. I mean, that's why we ended up with having some issues sometimes, right? Because
yeah,
some loans
yeah.
maybe should not be made.
Absolutely.
I mean, I don't know how else to say it. As a former lender, you know. Uh, but anyway, my other question is, why 3 years extension? Why not two? Why not five? How do you pick the three?
Um,
Typically, we don't do it for that
So I
period of
think
time.
the 3 years, the 2 years, the 1 year, the 3 years has always been the safe harbor, even when we provide financing under tax exempt. So the 3 years is just something that we generally would utilize as our framework whenever that we seek authority from the board. So we can go something shorter, but then it would be more administratively burdensome to come back every time.
And it
So
breaks my heart that you have to work a little harder. But I mean, this is not a bond. It doesn't go to the same. So the fact that it's more administratively,
yeah,
I'm not going to be able to sleep tonight if knowing that. But
understood,
of course, I'm being facetious, right?
right,
Uh,
understood.
but that's not a good excuse, in my opinion. But I was just curious. When we did this originally, was it for 3 year?
Yes, it was also for 3 years.
All right. Those are all my questions. Thank you.
Thank you.
I had one more question. I kind of recall this is an innovative thing that CHFA does. Is that true, or do other HFAs utilize this as a source of funding on a regular basis?
So I believe we are the first within the Federal Home Loan Bank of Boston's district. We recently had a call with a few HFAs within our district, essentially even HFAs, and they were mesmerized with CHFA in terms of how CHFA was able to get this product off the ground. So we've been sharing with them our notes and ideas in terms of how they should approach this product and what types of risks or analysis that they have to pursue before pursuing one. And then in addition to that, as a collective group, the HFAs, we're still negotiating with the Federal Home Loan Bank of Boston because part of the reason why it took so long to launch the program, and in my memo, I did state the dates between when we received board approval, which was February 2023, and the execution was first made in November 2024, is because the Federal Home Loan Bank of Boston does require multiple credit overlays that made the execution much more difficult. So the negotiation from the HFA side as a group is still ongoing. So Sarah, back to your point, it is innovative, but then we're trying to assist other HFAs so that they also can utilize the product.
Well, that's just another example how CHFA is an industry leader, and I know that to be true. Commissioner, another question?
It's more of a statement. I mean, because I have a lot of experience in financing, right? And reviewing other entities that do financing. This is very innovative in the sense that most people would never do this because it's not a good matching of sound lending policy that, typically if you're a bank, you finance it through deposits, right? If you're an entity like us, you finance it through bonds, not necessarily through a federal loan facility. That's not typically used to do it, 30-year, 35-year facility. So in that case is unique. If this was a traditional bank, that would not be looked at positive by the regulators.
Azim, you want to respond to that? Because you were saying that we use the the authority's resources to meet the mismatch.
Correct, correct. And I think it goes back to the mission of CHFA, which is to effectively leverage its balance sheet in trying to pursue its mission. So whenever that we have the opportunity to leverage our balance sheet, which is not measured by dollar and cents per se, but is trying to utilize our wealth. So effectively, the Home Loan Bank is relying on our wealth, on our ability to repay back what we borrowed from them, and then from there we're using that same proceeds to fund the loans that we are mandated to finance.
I want to make one more comment. If we were to bond finance this, because these are forward commitments, we would be taking market risk, because there's no way to really hedge that risk unless we did, some sort of derivative or other instrument to hedge it. But in using Federal Home Loan Bank, we are getting, and we're setting the interest rate on development at the time of the construction loan closing. We're able to match that with a borrowing rate from the Federal Home Loan Bank. So I think there's advantages, and it's a simpler execution in some ways than trying to procure a derivative or worse, use ITA, which, consumes liquidity.
Yeah, another way to also look at this whole financing is in separating between bonds and the Home Loan Bank execution is to view the Federal Home Loan Bank of Boston as an investor to the loan itself. So effectively, Home Loan Bank is putting up 70% of the loan proceeds, and then CHFA is putting up 30% of the loan proceeds to fund the whole financing.
Any more discussion? May I have a motion?
So moved.
Sorry,
Thank you.
second.
Thank you very much. Any further discussion? Questions? Seeing none, we'll do a verbal vote. All in favor, say aye.
Aye.
Opposed? Abstaining? The item passes on a verbal vote. Next item is the report on the last bond issue with RBC. Over to Hazim.
Okay, so this morning we have the pleasure of Corey Hapner being with us to talk about the recent sale that we did, our first single-family bond issuance. So Corey is the head for the housing group. From CHFA's point of view, the financing went really well. We were able to get a lot of orders, and additionally we're able to tighten the spread, but without going into too much detail, Corey, why don't you just jump in?
Yeah, thank you, Hazim, and good morning, everybody. So Section A of the post-pricing book that you have in front of you is really sort of the highlights that I want to focus on. We spent a...
Lorraine, can you go to... Yeah. So
Oh, there we go.
Yeah,
Okay, it's up here. Yeah, perfect. So we entered the market on Tuesday, January 27th, which was an important date on a couple of fronts. One, it was the day prior to the FOMC meeting. So we, as a finance team, including Hazim and his team, the Kane Mitter and CFX teams, we're very strategic and thoughtful about that week. In general, it followed a $12 billion volume week the prior week. And there's always a lot of noise around the FOMC meeting. We are a firm that does not shy away from that. Markets are markets. If you wanted to run from the FOMC, the PPI, the CPI, the jobs reports, you'd never find a day that is going to come without some market impact affecting your deal. So I think that was part of the focus from a timing standpoint. We were also very focused on what we call the January effect in our business, which is to say a lot of folks, shut down December 15th and thereafter in order to close out their books and their balance sheets for the year. And so by the time you get to January, you've got a lot of pent up demand and a lot of cash that needs to go to work. So naturally for us, entering the market with a strong credit like CHFA was a no-brainer for us. And as you look at the highlights within that page there, you can see, we had a $20 million small tax exempt piece and a $269 million much larger taxable piece that combined garnered more than 1 billion of orders. So I think what that says is CHFA continues to be one of the market leaders in terms of sort of best credits out there and most desirable credits in the housing space. I think there's a lot of noise around redemptions and around prepayments and around ability to repay on schedule and as planned. And I think there's not a better name in the market for us to sell than CHFA. So that certainly was a feather in our cap as we entered the market. We did have 56 unique investors on the taxable side. We had 12 investors on the tax exempt side. So out of those 68, 67 of them were unique, with only Nuveen purchasing both tax exempt and taxable bonds. So what that strong subscription levels allowed us to do was reprice the taxable part of the transaction by 2 to 5 basis points lower on the long end, and the tax exempt portion by 5 basis points on the long end. So really from a pricing power standpoint, and if you look back, I think it's section C that has the comps pages, you will see that CHFA priced better than any of the deals that had come prior and priced better than any of the deals that came after. So for this sort of first 6 weeks of 2026, with CHFA, dropped into the middle of the calendar, I think, the only other pricing that was close and comparable was Virginia, which is always one of the strongest trading and well-capitalized balance sheets in the HFA space. In terms of direct head-to-head comps, there was a Maine housing deal pricing on the same day as CHFA, which is a AA1, AA plus credit. CHFA was 10 basis points through those levels, when all was said and done. So at the end of the day, we had about 12.5 million of unsold bonds that RBC made a capital commitment to underwrite. We underwrote those bonds without cheapening levels. So from a capital commitment standpoint, certainly we value our partnership with CHFA, and we view it as a privilege to work with you all. And it was a super successful sale. They aren't always successful sales because markets are markets, but in this case, I think timing worked out to CHFA's benefit. And as I said, that January effect and overall desire for the CHFA credit remains strong. So with that, happy to answer any questions.
Any questions from folks? Sounds like a really good sale, and I love an underwriting without cheapening the scale. I love that.
There you go.
Good. And there's no more discussion on that. We'll move on to financial reports with Allison Murphy.
Good morning. Before you are the January financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 1 million under budget for the first month of the year and 4.2 million higher than last year. The increase in the authority's investment portfolio is a large driver of the year-over-year variance, as the portfolio is $904 million higher than the same time last year. On the expense side, interest expense is 2.2 million below budget for January and 3.6 million higher than last year. Propelling the prior year variance is the $896 million increase in outstanding bonds, compared to the same time last year. Administrative expenses are coming in 627,000 below budget and 116,000 lower than last year. When you exclude salaries and benefits of 2.6 million, current year expenses are 13,000 higher than last year. Bond issuance costs are coming in 1 million under budget for January. And as you just heard, the first bond sale of the year was just last week. So we expect to recognize the majority of the costs associated with that sale in February. And lastly, the change in net position is above target by $2.1 million. Now, on an additional note, I do want to respond to a question raised by one of the committee members last month about why IT and other professional fees were under budget last year. Due to an IT governance decision to proceed with cloud adoption, investments in certain IT-related initiatives were postponed to avoid duplicative or short-lived solutions. And then on that professional fees side, the multifamily operations department budgets for certain architectural and construction services, along with appraisal and market studies for our nonprofit developers, in addition to third-party underwriting services, all which were under budget in 2025. These budgeted line items serve as placeholders, not knowing exactly which of these services will be needed during the year. I hope that answers your questions.
Any other questions on the financials? Since you mentioned IT, it kind of raised a question in my mind, and we don't have to get into it deeply here, but how is AI going to affect the business of CHFA? Maybe with your loan originators, your servicers, or even what you do. Do you see a big impact, and are you looking at ways to utilize it as a tool for what we do?
I mean, I can start and we can see how far we can take this conversation right now, but we have adopted an AI policy internally, Sarah.
Okay.
Which has allowed employees to request, through a process that we created for usage of certain AI tools, mostly generative AI. And there's, an interest in using it to perhaps create a memo or something like that. So that's primarily how we're using it today internally. We are in discussions, and part of that is an IT strategy, is how to use it more in the business. So internally, I think we're trying to implement a series of, I want to say, sort of infrastructure and software capability that would allow us to warehouse all of our data in a way that would allow us to use AI predictively for business decision making. And that's, I would say, a couple of steps away, because we're in the process of updating, converting current applications, and then moving all of that to a data warehouse, which would allow us to essentially query and use AI for both enterprise reporting, but also AI reporting capabilities. So that's our internal focus right now, is to create that infrastructure and that business reporting and querying capability. In terms of servicers, I don't know, John, do you have any thoughts?
There's a general reluctance in the HFA industry, that, as I understand it, to use AI in servicing, and it's just the concern of putting that personal information out into AI and losing control of that information.
How about on
I
loan
could speak.
origination? Yeah, go ahead, Phil. Yeah.
It really hasn't developed yet. Like, we've done a deep dive in looking at it from the origination perspective as a company, and it's not there yet. I mean, it's a whole separate process. We keep our eyes on it, but I don't think it's mature enough yet. to be effective to use for CHFA at this time. But I mean, it's something that keep your eyes on, but it's using that to underwrite documents and scrubbing stuff I'll be honest, we've looked at 10 different systems and it's really not there yet. And what people call AI at some cases not really there. It's not really true AI. So it's kind of a growing, maturing, but it's great I think it's great that the team is doing a strategy, putting a strategy together, but it's from our perspective, we haven't implemented it fully yet.
Interesting. Commissioner?
Well, what we see out there is, I agree with Phil that it's not fully developed, but the industry is working on it, especially the larger ones, the Rocket Mortgages and the bigger entities. In fact, there was a study done and this is one of the reasons why it probably hasn't taken off fully yet, where this particular program that we're using ended up redlining, right? Because AI is not smart, right? It's a program, and it does whatever you program it to do. And what it did is it analyzed loans in a particular area. There were higher delinquencies than others, right? i.e. lower income areas and so forth, right? And there were larger losses in areas where the appraisals may vary much more, right? So there is a lot of risk to using AI. Concerning confidential information, you could have private AI agents, so that stuff doesn't have to go public. But I could tell you that there are some entities that are starting to use it somewhat. They don't use it exclusively to do underwriting, so they still check manually. So there's a lot of testing going out there, and our policy should include eventually vendor management, right? Because that's what it would be, right? Your loan originators, where we buy the loans from, in the future, if I was a betting person, they will be using AI because it's way too cost efficient not to use it. But I totally agree with Phil. Today, it has not developed to that level where we have to be concerned about it. But this is really advancing the knowledge, and it won't be far-fetched to say, 6 months from now, you may see more people using it. I mean, there's some quirks that they have to work out, but there's a lot of money and effort being put into this area because the savings is way too big for it not to happen, and the efficiencies. I mean, I'm doing a project in the agency with 3 Yale fellows, and there's a process that would take us, I don't know, maybe almost 3 days to do. And after they got through with it, I get the answer like in 1 minute.
Wow.
So the efficiencies are way too good not to dibble with it, and that has to do with scoping. Now, we don't use AI to do scoping 100%, right? We still go back and check it because we're not comfortable enough with it yet to say that should be the Bible. I could tell you that is also happening in loan origination, behind the scenes. So we should develop a vendor management process. So when we buy those loans from whoever we buy it from, a bank or a credit union or some other mortgage type of company, if they're using AI, then we make sure we're not, that they're in compliance with our beliefs and the law.
I want to add that when I was talking about it from the business perspective, I certainly was not envisioning using it for underwriting or anything like that in the near future. It was more from the perspective of using it for of harnessing existing data, perhaps, and complementing our current processes for analyzing patterns and trends, and making, using it in conjunction with other information. So definitely not looking at it from a solely for underwriting or anything like that. We know that's very much in its infancy. And so just wanted to make that clear.
Thank you. Sorry for
So,
taking
I
us
mean,
off
I
topic.
understood it that way, but all I'm saying is that we do buy loans from other people who originate loans, right? That is a
Correct.
question. Correct. And I'm telling you that I agree with Phil that nobody's really using that AI to that great extent today. But I'm also telling you that based on what we see and the reports we're getting, and if you read the national different mortgage journals, there are a lot of samples of entities who put a lot of money and effort into developing AI to do underwriting in the future. And all I'm saying is that part of our policy should be, how are we going to review those entities, when our audit department goes out, use of AI, and make sure that, we're comfortable with how they're using it. That's all.
Good points. Very good. So if there's no more discussion on that, let's move on to production and delinquency report. John Chilson.
Good morning. So loan purchasing volume remains still very strong. The authority purchased 329 loans totaling just under $100 million. That's one loan less than in January 2025, but $6 million and more in dollar value. That's with the increase in the average loan size to over $300,000 for the first time. The year-over-year increase, it represents a 6.6% increase in the average loan value, which is in line with what we're seeing in terms of the increase in Connecticut home prices. The 97% of January's production was securitized, leaving 10 loans and $3.5 million of whole loans. The mortgage-backed portfolio increased $75 million in January, while the whole loan portfolio decreased by $2.5 million to a portfolio balance of $1 billion. The whole loan delinquency rate was 6.7% through December, which is lower than the state nationwide averages, and the carrying balance of loans in foreclosure year over year declined by $1.4 million to a balance of $11.7 million. And for January, the authority also funded 81 down payment assistance loans totaling just under $1 million and 229 time to own forgivable loans totaling $5.4 million. The multifamily portfolio increased 3 loans in January to an overall 627 loans totaling $1.6 billion. There were 11 permanent loan delinquencies, which is unchanged from the prior month. And the multifamily delinquency rate is less than 1%. Any questions?
Seeing no questions, our last item for action is approval of the minutes of the Finance and Audit Committee meeting of January 22nd, 2026. May I have a motion?
So moved.
Second.
Second.
Any discussion? Call for a verbal vote. All in favor, say aye.
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 Opposed? Abstaining? The minutes are approved on a verbal vote. Any other matters to discuss for this committee this morning? Very good. We'll see you at the board meeting then. We'll vote to adjourn. All in favor, say aye.
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 Thank you.
Thank you.
Thank you.